So these tech declines, though, have prompted investors to pull about $7.6 billion from tech-focused mutual and exchange-traded funds through April. That's according to Morningstar Direct. So is the decade of tech dominance over? Well, we put that question to our next guest, Jeffrey Kleintop, Charles Schwab Chief Global Investment Strategist. So, Jeffrey, as you're looking at what we're seeing here, these corrections that we keep seeing in the tech space, is this decade of tech dominance over?
I think it is. And not that I think you need to get rid of all of your tech stocks or that, tech is going to be not an interesting place to take a look at for the next 10 years. But we often go through these bouts of relative performance, right, where growth stocks dominate, and then we see a shift to value stocks for many years. And that's kind of what we went through. In the 80s, it was really all about value. And then the 90s was about tech and growth. The early 2000s was back to value and led by financials. And then for much of the 2010s, it was really about growth and tech. And we're shifting back to an environment of higher inflation and more of a focus on quality and shorter duration stocks, meaning higher cash flow stocks. And that really does tend to favor other sectors than the technology sector. And so while I don't think you need to get rid of your tech stocks, I think just waiting for the safe sign to go back and buy more tech is probably not the thing you want to be doing right now. More broad diversification across many different sectors, many different parts of the market, I think will be much more attractive here in not only just the second half of the year, but for the years ahead.
Jeffrey, in just a couple of days, we're going to get that CPI print, the latest read on inflation. What are you expecting to see there? And do you think we've seen a peak in inflation yet?
Well, I hope we've seen a peak in inflation. My concern, 8.2% on Friday seems to be the consensus expectation, 2 back-to-back months of declines, and that might provide some relief. But here's the key. China has been offline for 2 months. It's now coming back online, and that means more demand for raw materials. We've seen copper and iron ore prices move back higher as China's reopened, as Shanghai's started to allow for movement in and out of the province. What we're seeing is maybe more pipeline pressures emerging in inflation. And I think that could mean that maybe we're past the peak, but maybe we don't get as rapid a decline as we'd like over the next few months, simply as China, which had been a now drag on inflation over the last couple of months, is coming back online and maybe a boost to inflation pressures for the next few months.
Jeffrey, Jared Blickery made the point earlier that it appears like the markets are waiting on something, both buyers and sellers. Is it that index, that inflation number later in the week? Is there some other piece of data that the markets are waiting on?
I think the inflation data is very important, but I actually think they're waiting to get to see what the earnings picture looks like. And the reason I say that is economic estimates have been coming down all year. Earnings estimates have been going up all year. Something's got to give. And I think now we've pushed down valuations to the point at which if earnings don't give up and begin to really see dramatic revisions lower, then maybe there's some support here and room for a bounce. The problem with that is Intel and Macy's, and what we heard from Target and others, that inventories have now grown to excess levels in a number of different channels. We've gone from shortages to gluts as rapidly as I thought that we would. And if that continues to be a problem, we're going to see further or new downward trend in revisions on earnings. So I'm a little bit worried about the other way, that the markets have found some support here in the last 2 or 3 weeks. But if that support, meaning earnings, starts to wind down with more and more announcements of excess inventories, price cutting, while that might be good for inflation, it might be bad for the earnings prospects and cause them to get lowered along with the economics. So look for that as we head into the earnings season here, as we kind of move through the rest of this month and get into the pre-announcement period.
And we're seeing a lot of retail investors, they're seeing these tech stocks that have been beaten down, they're pouring their money into them. But what are we seeing from institutional investors? What path are they going down?
Well, when I take a look at where the biggest buying is coming from right now, it's really from the companies themselves. What I found is that stocks that are engaging, or companies that are engaging in buybacks, are really doing well this year. Companies that are announcing new buybacks, if you take a look at the selective indexes for buybacks, the way of tracking companies that have increased their buyback over the last couple of months, they're basically flat year to date versus the overall market down double digits. So that's where the biggest buying is coming from in this marketplace. So continuing to track that in your screens may be a place to find some winners.
Jeffrey, there was a recent note out from DataTrack saying that $140 oil is, quote, the level to watch as a recession indicator. When you take a look at the sustained high price that we have seen oil trade at over the last couple of weeks. I guess how big of a barometer, how closely are you watching that in correlation to the possibility of a recession?
What's blowing my mind right now is that pick any major city in the world, there is no decline in driving activity. Traffic congestion is above last year and above 2019 levels for the same period of time in Sydney, Australia, in London, England, in Paris, France, in New York, here in the US. Everywhere around the world, no one's really pulled back. And that's telling me that while consumers are concerned about it, and they're showing that in terms of their pessimism on surveys, they're not yet curbing their activity. And of course, it's that activity that could lead to a recession.
Jeffrey, before we go, some bleak warnings out of the World Bank yesterday. If the world outcomes materialize, said David Malpass, global growth over the next 2 years could fall close to zero, with the term 70s-style stagflation being thrown about several times. How worried are you about stagflation and a recession?
It remains one of our top risks for the year. We continue to watch those risks very closely. I believe that the shift from shortages to gluts is going to help bring prices down later this year. I mentioned earlier that maybe China might be supporting inflation here in the near term as it comes back online. But as we look more out to the second half of this year, I do see prices coming down, inflation pressures receding, maybe less pressure on central banks to be as aggressive. And that should alleviate some of the concerns that are showing up in the World Bank numbers and the OECD numbers that came out today, and maybe see something more closer to average economic growth this year and perhaps next year than the recession that many fear.
All right, Jeffrey Kleintop, thanks so much for taking the time to join us.